Hi, this is Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. Welcome to the weekly Top 3, the top 3 things on our mind here at Alaskans for Sustainable Budgets for the week of November 18th, 2024. The weekly Top 3 is a regular segment on The Michael Dukes Show. The show broadcasts on both Facebook Live and YouTube Live, as well as via streaming audio from the show's website, weekdays from 6 to 8 a.m. I join Michael weekly in the first hour of Tuesday's show from 6:10 to 7 a.m. for a discussion between the two of us about our 3 issues. We post the podcast of our discussion following the show on the Alaskans for Sustainable Budgets Facebook, YouTube, SoundCloud, Spotify, and Substack pages, also on the Alaskans for Sustainable Budgets website, as well as the project's page on national blog site, medium.com. You can find past episodes of the weekly Top 3 also at the same locations. Keep in mind that in addition to these podcasts, during the week, you can also follow and participate in the discussion with us of these and other issues affecting Alaska's fiscal and economic condition by following us on the Alaskans for Sustainable Budgets Facebook page and through our posts on Twitter. This week, our top 3 issues are these. First, we discuss what Alaska realistically should expect from the Trump administration on resource development. Second, we discuss the coming legislative budget cycle and, based on the current oil outlook, what legislators likely will be facing when they arrive in Juneau in January. And third, we use a recent report on where Alaskans are migrating to help make our point about how to prevent it. And now, let's join Michael.
All right, Brad. Well, let's get started today with the weekly top 3. We got a lot of stuff to cover, and the big one here is some of your analysis based on your history as an oil and gas attorney and everything else, and watching the markets, as to what the new incoming administration, what does it mean for Alaska? Because there are some, while people are happy, and I'm happy as well, there are some downsides potentially for the state. Why don't you walk us through this?
Well, it's not so much downsides, Michael. I think as it is, don't think the upside is unlimited. That we're gonna, suddenly everything's going to open up and we can go mine and develop everything we want to develop. I know there's a great euphoria out there. There's a headline in the Alaska Beacon that says drill, drill, drill. New Energy Council signals Trump to prioritize energy production. And I know President Trump had the video that the Governor Dunleavy posted and distributed about how he's going to prioritize Alaska. But really, we need to be cautious about this. And not think that the skies have opened and everything's going to be rosy. Tim Bradner had what I think is an excellent op-ed on that issue in the ADN this week. The headline is, "What will Trump's election mean for Alaska resource development?" And Tim goes through the steps that it will take for Alaska resource development to really get off the mat here and sort of soar. And it's it'll be, lands have to be open, plans that were established during the Biden era have to be undone, have to be reversed. That takes time. Once areas are open, they have to go through environmental reviews to reopen lands, and then you have to go through environmental reviews for leasing, and then you have to go through environmental reviews for development. And so there's a lot of steps between where we are now and where we are down the road once all that's done. And Tim, I think quite rightly, looks back at the first Trump administration and says, look, a lot of these things were done. A lot of lands were opened. A lot of effort was undertaken to get ANWR open, for example. And what happened was the pendulum swung back. In 4 years. Biden was elected, and those things were gradually undone. Investors don't look at just a 4-year cycle. They don't say, investors in Alaska don't look at a 4-year cycle. They don't say, oh, we're going to open all this stuff and we're going to invest in all this stuff. And we're going to get ready to do all this stuff without taking into account, what's going to happen in the 4 years after that, or the 8 years after that, or the 12 years after that. Alaska, unlike areas in the lower 48, Alaska is definitely characterized by long lead projects. That is, it takes a lot of investment, it takes a lot of work, takes a lot of development up front to prepare for the development of a given resource. And so you don't look at just a 4-year window. Can I get it all done? Can I get my money? Can I get my money out in 4 years? Because you can't. You need to be looking at a 10, 20, 30-year window. And you need to be taking into account whether you're going to be able to, whether there's going to be a consistency of regulations over that period of time. So we need to. I think Tim's last line, or next to last line, was a good one. It was a plea to new President Trump: be cautious. And what Tim was saying there was, look, we need to. Part of the problem with what happened when Biden came back in was a bunch of the environmental reviews that had been done during the Trump administration were either reversed by Biden as deficient, or on appeal to the courts were ruled to be deficient. And I think what Tim is saying there is, look, do the groundwork, be thorough in the approvals you give, be thorough in the reviews you do, to make them appeal proof or to make them reverse proof down the road, and take the time it takes to do that stuff carefully. Where the real boom is from the drill or the drill baby drill mantra is going to be on federal lands in the lower 48. And there you have a situation where there's been a booming oil industry on private lands in the private and state lands in the lower 48 from fracking and from short cycle oil shale development. And you have federal lands that are thought to hold the same potential as the state lands that have the oil shale state lands. But those federal lands have not been opened during the Biden administration. And I think where the real excitement is in the industry, when you look at the industry as a whole, not just the Alaska segment, but the industry as a whole, is with respect to those federal lands in the lower 48 that have oil shale potential and can be developed relatively quickly, are adjacent to existing oil shale fields and can be developed relatively quickly once they're open. They also have to go through the review process. The Trump administration needs to be careful about authorizing those as well to make sure that they're appeal proof. But they are going to be on a much quicker cycle. And once they're open, they're much easier to develop than Alaska lands are. Again, they're short cycle shale, as opposed to, and you're just sort of moving a rig onto federal lands from state lands,
right,
from private lands. Those are easier to develop. So when you hear people say drill, the potential is huge, we're going to open up, a lot more lands to development, what they're really talking about is federal lands in the lower 48. Alaska has a potential, and we certainly will benefit from a more resource development oriented administration than we've had with the Biden administration. But it's not going to be just like that, and all of a sudden everything's going to,
right. And I thought that was interesting. Yeah, I thought that was interesting that Bradner talked about, that this was it's a long tail, even when Biden was trying to undo Trump stuff and when Trump was trying to undo some of Obama's stuff. This was not an overnight snap your fingers, wave your magic pen and make it happen. In some cases, it took almost all 4 years to be able to reverse that. Not to mention the fact, like you said, that the stuff here in Alaska is a much longer lead time for most of those projects versus some of the easier projects down south. And then overall, the other challenge, of course, is the more oil and gas exploration that is done, the overall price in the market continues to drop, which in turn has knock-on effects for Alaska in other ways as well, not just in the industry development, but in state revenues and other things.
We'll get to that in the next segment. There certainly is a knock-on effect.
Yeah.
But you're exactly right about that. I mean, the more development you have, the more supplies on the market. There's an article in Bloomberg's this morning that talks about that exact issue. I mean, IEA, OPEC, IEA, one of the two, has already identified. I think it's OPEC has already identified that there's 1 million barrels a day that's going to be surplus in 2025 that we've developed and we've developed and we've developed, but the market has shrank a little bit, and so they're talking about 1 million barrel surplus. If you layer on additional development on top of that, I think one estimate I saw in the Bloomberg article was 2.5 million barrels a day of surplus, and that will have a very, very depressing effect on price. When at the margin you've got a surplus of that size, it's about 2% of production, 2% of the market. You're going to have a depressing effect on price. So, yeah, that'll do it too. That, interestingly enough, that doesn't affect Alaska projects as much as it affects the lower 48 projects, because Alaska
Right.
projects have been set in motion a long time ago. Investments been made. Willow won't change, for example, and Pico won't change because of gyrations, short-term gyrations in price. But in the lower 48, where you have short cycle fracking development, shale development, where they can turn on a dime, that'll have an impact on development down in those lands. So we're insulated to some degree up here by the fact that we're long lead, but that also has the consequence that we're just not going to quickly pop up with new developments.
Elevator pitch it for me here, Brad. 60 sec, just a synopsis of what do you and Bradner and everybody, what's the overall look for the administration in the state of Alaska? It's good, but with caveats, or what's the final pitch here?
It's positive with the caveat that you've got to, investors have got to see a 10 or a 20 or a 30-year horizon where it's going to stay positive. They're not going to invest on a 4-year outlook that looks positive, with the potential that after that would go back to a Biden administration or go back to a Democrat administration that undoes a lot of that stuff. So it's positive in the sense that lands will be opened, access will be opened, but it's not positive yet in the sense that we're going to that anybody anticipates a huge chunk of new investment coming in as those lands are open. It's going to be very gradual, and it's going to take a long view that this same sort of pro-resource development policy is going to sit out there.
That's always been the problem with Alaska, though, right, Brad? Is that everything that we're doing here it seems like it always takes a lot longer in Alaska than almost any place else. And that's a function as much of regulatory and environmental as anything else, combination of those things. But it's always been one of our, I guess, the major Achilles heel is that everything here takes a little bit longer and costs a little bit more.
Yeah, I think that's accurate, Michael. But it also, I mean, the price fluctuations also shows that to some degree we're insulated from short-term effects, short-term consequences as a result of that. I mean, we're not going to, even if prices go down to the 60 barrel or even 50 barrel range, we're not going to see Willow shut down or the Pico development shut down. Once we get something going, once we get a project underway, it tends to stay underway, sort of like the law of inertia, right? And Willow, I think, shows that once you get a project underway, even in one administration, Willow was really sanctioned in the Trump administration. Once you get a project underway in one administration, if it is far enough along and it has enough support, it'll survive the next administration. So I think I don't think that we're talking about going backwards here, certainly, but I don't think we're talking about taking a great leap forward. I know some people have jumped on the Trump video and said, "Oh my gosh, the gas pipeline's now right around the corner." It's not. I mean, the gas pipeline has a whole bunch of economic problems that are going to continue to drag it down. Even if it has all the interesting thing about the gas line, it has all the permits really that it needs. So the Trump administration doesn't need to be permit happy to get the pipeline going. It's got the permits. It needs investment now, and unless the federal government is willing to come in and essentially pay for it, the economics still are extremely challenged. So there's just, I mean, the euphoria is justified to a degree in terms of making things easier and opening up some things that haven't been opened. But the euphoria is not justified in the same sense that some of the lower 48 are having it, which is okay, open up those federal lands and I'll just get the drill bit in there
Right.
the next day. That's not the way things are going to work up here.
Right. And it's interesting to hear more about some of the other states and their short-term fracking things, and I hadn't considered the fact that you have a federal land adjacent to existing projects and things like that. That does make it more efficient and quicker to jump on those balls, especially in the short term.
Yeah, and there's access. I mean, there's access to even where you don't have them adjacent, as you do in New Mexico, for example. Even if you don't have them adjacent, I mean, there's roads from point A to point B, and there's ways to get development underway in a way you don't have
Right.
as easily up here. So the euphoria that you're seeing in these headlines about drill baby drill, now we're going to go forward, we're going to be energy dominant, all of that is more justified in the lower 48 than it is in
Yeah,
Alaska.
right.
We're going to have some blip in terms of additional access and additional uh, lower lesser permit impediments, I guess, maybe a way to put it. Lower permit impediments, but it's not going to just jump up and all of a sudden open up doors to development that we haven't been doing.
We'll have to answer this one in the next break because we're running out of time here. But Anthony's got a good question. He says, I may be thick headed, but how are we insulated from inflation or fluctuating economy on longer projects? In my simple brain, if I give you 10 million to do a job, you quote that job out year one, but on year four, the price of goods goes up 25%. Isn't your budget now in deficit? He said, I may be overthinking it.
So oil companies, I'm looking at it from the oil company's perspective. They do two things to protect against that. One is they 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 send out the bids and get commitments when at a certain time, but the commitments are for long lead items. So if you're going to get rig or you're going to get pipe or you're going to get something, then the bid's due on a certain date. The commitments are made on a certain date, and if inflation occurs after that in the costs of production, those are eaten by the contractor, not by the producer, and the project still goes forward. And that's the perspective that I'm taking on that. The other thing is that on these long lead items, production companies, producers tend to include healthy contingencies for those sorts of things, the cost escalation that may go on during the course of bringing the project together. Pica is a good example of that. There's some significant cost overruns that got reported on the Pica project, at least reported in the Australian press, because that's where Santos's home is. Some significant cost overruns in Pica, but Santos said, "Yeah, we expected that. We still get a healthy return. We're still going to get a healthy return out of the project, even despite those increases." So when you put together a long lead like that, you're hedging part of it with long contracts, that will have delivery fairly far out into the future, but you've set the price now, and you're hedging another part of it with the contingency. They do affect projects. I mean, the increase does affect projects, but you got to remember the other thing about Alaska that's different, a little bit different about Alaska. In the lower 48 with short cycle projects, with the oil shale projects, the wells don't produce very long. And so you're always stepping to the next well and the next well and the next well. One early on, some people just liken that to a manufacturing process. You produce a widget, you go on, you produce the next widget, the next widget, the next widget. And you're getting some longer lives out of some of these wells now in fracking, but still that's sort of how it goes. So you always have new costs that you're incurring. In Alaska, you tend to have fixed costs. You have some incremental costs in terms of operating costs, variable costs, and you have some incremental costs in terms of additional wells you need to drill. But it's nothing like's going on in the lower 48. So
Right.
it's a different environment that enables you, with a combination of fixed contracts, fixed price contracts, accommodate and the contingencies you put in, and the fact you don't have those ongoing costs in the same way you do in the lower 48. You tend to be able to ride out inflationary hits and cost increases better than in the lower 48.
All right, we're continuing with a weekly top three. Brad Keithley, Alaskans for Sustainable Budgets, is our guest. We're going to continue here. The coming budget cycle is Brad's number two, and that also includes some kickback and some, like I said, knock-on effects from what's going on with the drill baby drill mentality. Brad, what does the upcoming budget cycle look like?
Well, this got triggered in my brain as a segment based on an article in the Fairbanks News Miner, the headline of which is UA Board of Regents approved $365 million state funding ask. And the thing that really triggered my brain was this passage. It says the University of Alaska Board of Regents voted in favor of a $365.6 million funding request from the state at its meeting on Friday. The ask is $35.6 million, nearly 10% more than what was requested last year, according to a UA News release. And it goes on to, what makes up that 35.6 million additional from last year's request. And I was sitting there going, 10%. They're asking for 10% more in spending. Well, let me go back and see where we are right now in our various budget cycles. And I have a chart that I do weekly that I could easily modify into a chart that shows where we are now. If you have that, it might be useful to pull up. This shows the FY25 budget, the budget we're currently in. And the budget is divided into a lot of pieces. There's a baseline, which is the break-even point in the current budget, and that's $75. And then there's another baseline at $78, where revenues above that amount are shared between the PFD and going into the CBR. But below $78, there's no sharing, and below $75 a barrel, we're in deficit. The current projected price based upon the futures market, and we're about 40% of the way through the year, so we're beginning to see a price range that's going to pretty well define where we are in FY25. The current based on the current futures market, the FY25 average oil price is around $73, $2 below the $75, and that's a deficit, an absolute deficit. That is, we have less money coming in than on which the budget is predicated, an absolute deficit of about $100 million. When you go to FY26, we're looking at the same sort of thing. We're looking at the futures price giving us a much lower price than was projected in the spring revenue forecast. And if you took the spring revenue forecast and said that's what we're going to base the FY26 budget on, then you're showing the same sort of deficit in the FY26 budget as you're showing in the FY25 budget. So we've got agencies out there. I mean, we've got people out there that are saying, oh, we need increased K through 12 spending. We need increased, defined benefits spending. We need increased spending on this, that, and the other thing. And we've got a revenue picture that shows that we're underwater. Not just that we're not breaking into the revenue to the surplus that's shared between the PFD and the CBR. We're in a deficit situation for FY25. And again, if you look at FY26 and said we're going to take the spring revenue forecast as the baseline for FY26, we're in a deficit for that as well. We're not even paying for what we've already appropriated. We don't have enough revenue right now to pay for what we've already appropriated, much less
in the
layer on additional spending on top of that baseline. So when I see things like, the university requesting nearly a 10% increase over what it requested last year, which is more than 10% against compared to what they got last year. When you see that sort of increase, you go, what are these people drinking or what are these people smoking? That is not the state. That is not the state of play that the state's in right now.
No, I mean, because again, if you start to look at this and you realize, again, you're talking about this chart is the current fiscal year, the current year, meaning
Right.
we're already upside down in the current year, which means there'll have to be a supplemental bill at the beginning of the next session to pay for what's been undersold for this year, a couple $100 million, maybe more. And then next year, I mean, just the two items that they're talking about, the BSA, if it goes to the full 14-13 increase, that's $600 million. And then the defined benefits plan, which the Reason Foundations said could cost by their estimates upwards of between $700 and $900 million a year. Well, you're already at $1.3, $1.5 billion increase, and we're already upside down for the current fiscal year. Where's that money coming from?
Michael, where it's going to come from is where it's come from for the last 7 years. It's going to come from PFD cuts, and so what we're facing is even higher tax rates on middle and lower income Alaska families to pay for this stuff. Forcing them to have even lower income than already was projected. And what the legislature will do is sort of mush these 2 years together, and there'll be some magic dust thrown on it, and PFD cuts will be made in the next fiscal year that will then sort of back up and help cover for this deficit in the current fiscal year. But we're not we're not paying. We don't have enough revenue to cover what we've already appropriated, and so this magic of this magic impression out there that people have is, oh, we have enough money, we'll increase spending, and we're going to increase spending here, there, and everywhere. Just isn't it isn't going to be what the new legislature is stepping into.
Right. Well, I mean, and based on that, because the leftover PFD itself is only just over $1 billion, right? For the leftover PFD. If it's 1.2, 1.3, 1.4 billion in extra spending, that means there's nothing, right? I mean, that's essentially what happens. If they increase the spending by over $1 billion, you've pretty much absorbed all of the leftover PFD at that point.
You could have a situation where if people go wild on spending, saying, as Bryce tried to say when he was announcing the formation of the new majority, that the spending cap is the full POMV revenue. That's our spending cap, which assumes in that the PFD that you just sort of captured, take all the PFD. If people walk in and saying, well, that's our revenue cap, I mean, that's our spending cap, and we got plenty of room left, you could, with the right combination of things, you could end up with a zero PFD out of all this. If not next year, then shortly thereafter, because the oil futures prices stay down over the longer term as well. So, but it's just, I mean, we've had this election cycle where people talked a lot about, more spending. People ran on more K through 12 spending. They ran on childcare spending. They ran on defined benefits spending. They ran on, spending on this, spending on that, a bigger capital budget. We haven't, people say we haven't had much of a capital budget in the last few years. We need a bigger capital budget. And they all ran on spending. Well, they're about to hit the wall where the revenues aren't keeping up with their promises. And in fact, the revenues are running away from their promises. They're running in the opposite direction of their promises. And I don't think the legislature, I don't think legislators as a whole, or maybe even many of them individually, are prepared for the type of revenue picture they're going to be faced with when they get down to Juneau.
Well, I mean, this was the number one thing that we talked about when you said, the thing that we need to be talking with all the legislators about. And that, of course, is the question of, okay, great. You want all this stuff. Who pays? Who pays in the long run? And the bottom line is that people, you get what you voted for. Apparently, people voted in all this big spending idealists going into the thing. There's going to be no PFD. And because of increases and because you've voted in people who are nothing but let's spend more, not only will there be no PFD, this will hasten the need for additional revenues, which means it will hasten in some form of taxation.
Additional taxation, keeping in mind that PFD cuts
Exactly.
themselves are taxation.
Official taxation.
Well, taxation that satisfies Randy's definition. How about that?
Yeah, exactly.
But yeah, I mean, revenues are important, folks. I mean, legislators and particularly during election years tend to ignore revenues, but revenues are critical. It's a balance sheet. It's kind of balance between the two. Income statement, you got to balance between outflow and inflow, and revenues are important, and the revenues are going down. I mean, you look at oil prices, and you look at production volumes. I haven't mentioned production volumes are running below projected in the spring revenue forecast as well. Not as much below as oil prices are running below, but production volumes are running below as well. So when you factor those two in, the revenues aren't looking like what we thought they were going to be for FY25, and they certainly aren't looking like what people have been hoping they would look like to balance out their spending plans for FY26. This legislature is looking a lot more like um, a revenue constrained legislature than it's looking like a revenue surplus legislature. And
But is it really?
we're not set up well for a revenue constrained legislature.
But is it really revenue constrained? I mean, really? Because they're acting like they're acting like the sky's the limit. They're acting like we got gobs of money. I mean, that's what is it really a revenue constrained legislature, or is it just we're too big to fail? We'll do whatever we want. Let the chips fall where they may.
Well, again, Bryce, when you look at what Bryce's press release said when he formed the majority, the spending cap is the total POMV draw, and if you're looking at that as your spending, there isn't any PFD left because the PFD is part of the POMV draw. And then it got layered on when James Brooks had the conversation with Chuck Kopp. All of a sudden, another principle got added to the majority coalition, which is no oil tax change, no oil tax reform. So, I mean, they're closing down revenue options faster than
and Will Stapp's position that he'll join the binding caucus, but only if they supplement Alaska gas development in some way, royalty relief or credits or something else. That's only if we burn Alaska gas will he. So I mean, the whole thing is just money, spend it. Projects, new things, new pet deals. That's the whole bottom line. Final thoughts here, Brad.
Well, we have a big appetite for spending. We're not going to have the revenues to do it, so something's got to give. And the something is either additional taxation through regressive taxation through PFD cuts, or they'll actually constrain spending, which is a hope, I suppose.
Wow, that was a real positive. It's a hope. I mean, pigs may fly out my backside, but hey, we'll see what happens. All right, Brad Keithley, Alaskans for Sustainable Budgets. The weekly top 3 continues. We have been talking about out-migration on this show for, well, I think the whole time that Brad and I have been talking together over the years. It's a constant problem. It's been going on for at least as long as Brad's been on the show. This is 10 years, Brad. You've been on the show for 10 years now. And we've been talking. It's been a problem since then. And it's been exacerbated by recessions and COVID. And then even in the midst of all the other recovery, we're still seeing an outflow. But what's interesting is to look at the demographics of it and where these people are going and everything else. That's number 3 of the weekly top 3.
Yeah. So there's an article in the ADN published yesterday. I think it's a pretty good article. It says, the headline is, as more Alaskans continue to leave than arrive, here's where they're moving. And it's a look at the Census Bureau data that's trying to identify when someone leaves Alaska, where are they going? And they've identified 4 states that people are moving to: Texas, Oregon, Washington and Florida. So two Northwest states, Oregon and Washington, and two Southern states, Texas and Florida. The thing that I looked at quickly when I saw that is, okay, so we say that Alaska has an advantage in terms of being a no tax state. It's not true. We do have taxes. PFD cuts are taxes. They take the most from middle and lower income Alaska families. But we say we're a no tax state. So people are moving to these other states. How do they line up? Are they moving because are they moving to states that also have no taxes? Now, only one of these states has an income tax. That's true. Oregon has an income tax that varies between 4.75% and 9.9%. But people are moving there. It's one of the four states that was identified that people are moving to. The other three states have hefty state sales taxes. Texas has no income tax in Texas, but it has a 6.25% sales tax. Florida has a 6% sales tax, statewide sales tax. Washington has a 6.5% state sales tax. So people aren't moving to states that have no taxes. They're moving to states that, in fact, have taxes. They're choosing states that have, for the large part, hefty sales taxes. And the one state that doesn't, Oregon, has a fairly hefty state income tax. What that means to me is Alaska's focus on the fact that we're a no tax state, and so people want to come here because we're a no tax state, is wrong. We do have taxes. We have PFD cuts. They are heavier for middle and lower income Alaska families than even these sales tax rates. We are taking income out of Alaska families through PFD cuts, and they're choosing to move to states that have, in fact, lower tax rates for middle and lower income Alaska families through these sales taxes than what they're experiencing in Alaska. I think it helps support the argument that Ben Carpenter's been making that what we should do is replace the current PFD tax structure with sales tax. And we could do that with a much lower sales tax, a much lower impact on middle and lower income Alaska families, and a much lower impact on Alaska as a whole than what you're seeing in these other states. Ben's proposal was a 2% sales tax. About 1.5% of that was to replace the PFD. The remainder of it was to replace a portion of the corporate tax that he wanted to reduce. So let's just focus on the 1.5%. Alaska could maintain the PFD, could maintain the income level that PFDs produce for middle and lower income Alaska families, and by just offsetting it with a 1.5% sales tax. Middle and lower income families would gain. They would gain more in terms of income from the PFD than they would lose through the PFD tax, through the sales tax. And in fact, the gain is significant. We did an article on it. Well, during Ben's campaign, we did an article that was published in the Peninsula Clarion on that, and we've done a couple of articles in the Landmine on that. The gain for middle and lower income Alaska families is significant.
Well, so and again, just give us a snapshot of that, because again, middle and lower, if you're talking about middle income folks, we're talking about, they're seeing a tax on their family, of the average family of four, of what, 10, 12, 14%?
6%.
Oh, 6% in the middle.
6% in the middle, and then it goes up to 15% by the time you get to the low 25%.
Right. So three times as much as they would experience with a 2% tax then.
Yep, exactly right, Michael. And so what we're doing is we're essentially forcing people out of the state by reducing their income. We're essentially forcing people out of the state. We're making Alaska less economic for middle and lower income Alaska families. The ones that are leaving, when you look at the data, the ones that are leaving, the ones where we're having the out migration is in the middle and lower income brackets. The top 20% income bracket is actually growing. We're having in migration for in the top 20% income bracket, but we have middle and lower income Alaska families leaving. They're going to sales tax states, largely sales tax states. It's not that they're against the sales tax, because they're moving into into states that have a sales tax. And if Alaska did the same thing, if Alaska did the same approach of having a state sales tax to support government as opposed to using PFD cuts, we would increase the income of middle and lower income Alaska families, increase the economics for them to stay in Alaska. So
Right.
I think this data is interesting in the sense that it shows we can do better than those states that they're moving to in terms of economics, in terms of family economics. We can do better than those states they're moving to. We can make life better in Alaska, life more economic in Alaska for those families. But we're choosing not to do it for some reason. We're choosing to continue a tax structure which forces people out of the state into other states instead of making an attractive state to stay in Alaska.
Well, and I think another thing that I took away from this was there was a phrase in there that says the why of why this is going on is pretty simple. There are fewer young people coming to the state, and those who are already here are leaving for retirement. It used to be that in the late 2010s, when the statewide recession began, that what was once a dependable population boom of adults in their 20s and 30s started to decline. And that again goes back to, I think, part of this disconnect between the public and the private economy. The public economy may be doing well, but people are attracted to the opportunity in the private economy. And because the private economy has been kicked to the curb essentially, and they don't really care about it, it's no longer as attractive to people in their working middle years of the 20s and 30s there. And those are the people that we're losing in that regard. They are no longer being attracted to Alaska because it used to be the land of opportunity. And now people feel like it's not really happening.
Yeah, I think that's right, Michael. I mean, we're taking more and more of Alaska income that used to be over in the private sector and moving it over to government, and government's redistributing it in whatever fashion government decides to redistribute it. And it's not being redistributed in a way that, as you say, is attractive to working Alaska families. It's being redistributed in a way that grows government, supports government spending, supports government employees, but it's not supporting the private sector. And so people are showing that they're willing to move to states that have sales taxes. They're willing to move out of Alaska to get out of here and incur taxes. If we used a more flat, a more average tax, equitable, thank you, more equitable tax structure, we could retain them here. We're pushing them out of the state through the tax structure that we're using. We're pushing them out of the state through relying on PFD cuts to fund government. And we're pushing them out of the state by taking more and more and more of that income and moving it over to the government side as opposed to the private side. We don't have to do that. We can do it in a better way, and we can do it in a way that's a lot more competitive with the states that we're losing people to.
But then again, we'd have to ask the question of who pays, right? Which it seems like there's nobody that's really willing in the leadership of the government to ask those things. 90 seconds here, Brad. Final thoughts for today.
Well, I think I didn't mean to be a Debbie Downer today, but we're facing a lot of challenges. I mean, we do have some upside with the Trump administration, but let's not overblow that. And we've got issues, definite issues with the budget that are coming up in the next legislative session that are going to be very challenging, I think, for the legislators that go down there. And then the third segment is there is a better way to do it. It involves sales tax, or it involves some sort of flat tax, but it would increase income to middle and lower income Alaska families, the very families we're losing to these other states.
Yeah, no, I mean, a more equitable tax would make sense, and again, it would put some skin in the game. Again, we're the only state in the nation that doesn't depend on the private sector to fund it, and we could see the detriment of that here played out writ large in the state of Alaska. Anthony says, can you really blame younger people for not coming up here, though? The cost of living and building up here is preposterous. The availability of any kind of job outside government or being in the trades is extremely limited. look at a $350,000 home here in Alaska versus the lower 48. Up here, you're lucky if you even get running water. I'm not blaming them. I'm saying this is indicative of that whole problem. I mean, that's part of the problem between the cost of living and the taking of the PFD and everything else, the cost to people to fund government. It's, of course, I'm not blaming them. I'm saying that's part of the problem, Brad.
It is part of the problem, Michael. And the solution, this is the thing that, you'd laugh if you weren't crying. The people think, you talk to people about this issue and people think, well, government needs to spend more. Government needs to bring down the cost. Government needs to spend more to offset the cost of living, to pay for things through government, and to pay for housing through and spend more to bring housing costs down through government. Government needs to spend more. That's the exact reverse. I mean, picking up on Anthony's point, that's the exact reverse of what we need. We need more income in the hands of individuals. We need more income in the hands of entrepreneurs than in the hands of government. And that more income in the hands of individuals will mean the impact of the cost of living, higher cost of living, is less because they have more income. And it will mean they have the means to improve themselves by, investing, or by doing starting a business, or doing whatever they do with the additional income. We're going at this in the exact reverse. We've got a problem with out-migration. The problem is not more government spending. The solution is not more government spending. The solution is more private sector spending, more income in the hands of the people. And, when you look at the states they're moving to tax states. They're moving to high sales tax states, at least if you look at the sales tax rates. They're moving to states that have taxes. People are willing to pay taxes, but in Alaska, we're taxing them in a way that pushes them out. We're taxing them at rates that push people out into other states, as opposed to using a tax structure that's flatter and brings middle and lower income Alaska families in.
Well, and specifically with Texas, they're also moving to states where the private economy is booming, right? I mean, that's the other thing, is they're looking at places, Texas and Florida specifically. Both of them are known nationally right now for basically having private economy booms. And so it shouldn't be surprising that is what's attractive to people more than anything else.
Booms based on private sector. Booms based upon the private sector.
Private economy. That's what I meant. Private sector booms is what's going on. And so it should be no surprise that that's where they're going. And they did it through a variety of things. But again, with a fairly low tax structure and a private economy that's doing great, of course it's attractive. But again, the legislature here, private economy is an afterthought if they think about it at all.
And when you say a fairly low tax structure, 6% sales tax isn't a fairly low tax structure. But we've got a tax structure for middle and lower income Alaska families that's even worse than that. So we have the opportunity. What we have the opportunity to do is to make the cost of living easier by increasing income, reducing the tax burden on middle and lower income Alaska families by spreading it out, taking Ben's proposal to spread it out, reduce the burden on middle and lower income Alaska families, let them keep more of the income in their pockets, and let them do things with it as the private sector, as opposed to depending upon the government to do it. We're about to make it worse when we go into a legislature that says, we need to increase government spending to make life better. We need to increase government spending on K through 12. We need to increase government spending on defined benefits. We need to increase government spending on that. Where's it going to come from? I mean, we had this in the second segment, right? It's going to come from more and more being taken out of individual Alaskans' pockets, making the cost of living problem worse and worse and worse by reducing their income.
The doom loop, right?
Yep.
I mean, that's the thing. Anthony says that people need to realize that government doesn't have money to spend. They're spending our money. So when you spend government money to reduce the cost of living, you're just taking more money out of the pockets of people who are trying to adjust to the cost of living. I mean, it is a self-licking ice cream cone. You've got to stop.
Yeah, the best example of that to me is that using PFD cuts increase poverty levels. Poverty levels increase the need for government support. Increased government support means increased government spending, which means lower PFDs, which means the need for more revenue. So lower PFDs. Right. It's just it is a doom loop. It is a death cycle.
Right. Well,
death spiral.
And that continues up till the point to where there is no PFD, and then there has to be taxes to cover the difference. And then those taxes are spread out on a group of people who say, I don't want to do that. So a percentage of them leave. The same amount of taxes are now pressed on a smaller group of people, which forces another cadre to leave down the road, which is a small, again, it's a death cycle. That's exactly what it is.
And we have the opportunity to break it. I mean, what Ben's proposal did was break that cycle. It says we're not going to use PFD cuts to tax anymore. We're going to take that burden that's now sitting almost entirely on middle and lower income Alaska families, and we're going to spread it broadly and reduce the burden on middle and lower income, reduce that excess burden on middle and lower income Alaska families, and make them economically better. I mean, that's the way to break this doom cycle, to make people better off. Not to pile on more and more government spending that has to come out of their pockets, to make people better off economically. And the way you can do that is through an equitable sales tax or through a flat tax, either one.
Ben is going to look like a wise sage when this is all over, because it's all going to lay out, I think, just the way that he said, unfortunately. Brad Keithley, Alaskans for Sustainable Budgets. Thank you, my friend. I appreciate it. Thank you for coming on board.
Michael, as always, thanks for having me.
Happy Thanksgiving. We'll see you afterwards. All right.
I look forward to it.
Enjoy some turkey.
Well, that's a wrap for another week's edition of the Weekly Top 3 from Alaskans for Sustainable Budgets. Thank you again for joining us. Remember that you can find past episodes on our YouTube, SoundCloud, Spotify, and Substack pages. And keep track of us during the week on Facebook and Twitter. Just so you are aware, we're taking a break during Thanksgiving week. But we'll be back the week following, and we look forward to you joining us again on December 3rd for the next edition of the Weekly Top 3.